Most Americans remember the 1920s as a golden age. The image is deeply embedded in the national imagination. Flappers dancing the Charleston in speakeasies, jazz music pouring out of radios, shiny new Model Ts rolling off assembly lines, and the stock market climbing higher and higher into the clouds. It was the era of Coolidge prosperity, a time when, according to the popular story, America had never been richer, never been more optimistic, and never been more confident in its future. But that story is not entirely true. There was another America in the 1920s, one that does not appear in the history books as often. It was an America of failing farms, crushing debt, stagnant wages, and a financial system built on sand. And if you look closely enough at that hidden America, you begin to see something unsettling. The seeds of the 1929 stock market crash were not planted in October of that year. They were planted years earlier, buried beneath the surface of the prosperity myth. To understand the true origin of the 1929 crash, we must first understand what historians have gotten wrong about the decade that preceded it. The common narrative is simple. After the First World War, America experienced an economic boom. Manufacturing expanded, consumer goods became affordable, the middle class grew, and the stock market, which had been relatively quiet for years, suddenly exploded upward in a speculative frenzy that culminated in the great selling of October 1929. That narrative is not false. Parts of it are accurate, but it is dangerously incomplete. Because while the cities were booming, the American countryside was quietly collapsing, and that collapse would eventually help bring down the entire economy. Let us begin our investigation not on Wall Street, but on the American farm. During the First World War, European agriculture had been devastated. American farmers stepped in to fill the gap, exporting vast quantities of wheat, corn, and cotton to feed a starving continent. Prices soared. Farmers borrowed heavily to expand their operations, buying more land, more equipment, and more seeds, confident that the good times would never end. But when the war ended, European agriculture recovered. Demand for American crops collapsed almost overnight. And with it, crop prices fell through the floor. In 1919, a bushel of wheat sold for over $2. By 1921, it had fallen to less than $1. Farmers who had borrowed to expand found themselves unable to repay their debts. Banks that had lent to them found themselves holding worthless collateral. And the agricultural depression that began in 1920 would last for the entire decade. While the stock market was soaring in New York, farmers in the Midwest were going bankrupt at an alarming rate. Farm foreclosures became common. Rural banks closed by the hundreds. And a quiet, desperate anger began to spread across the American heartland. But the cities did not notice, or if they did, they chose not to care. Urban America was enjoying its own version of prosperity, and it was a prosperity built largely on credit. The 1920s saw the rise of consumer financing on an unprecedented scale. Americans could now buy automobiles, radios, refrigerators, and washing machines on installment plans, paying a small down payment and then making monthly payments over time. It sounded like a miracle, but it was also a trap. By 1929, Americans were carrying more than $6 billion in installment debt. That is roughly the equivalent of nearly $100 billion today. And that debt was not just a minor burden. It was a structural weakness in the economy. Because when people are stretched thin on their payments, they cannot absorb financial shocks. And when they cannot absorb shocks, even a small downturn can become a catastrophe. There was another structural weakness hiding in plain sight. Wealth inequality in the 1920s had reached levels not seen since the Gilded Age. The top 1% of American families controlled nearly 40% of the nation's wealth. The bottom 90% controlled barely 20%. This meant that while the rich were spending heavily on stocks and luxury goods, the vast majority of Americans were living on the edge, one missed paycheck away from financial ruin. The consumer economy depended on the spending of the wealthy and the borrowing of everyone else. And when that borrowing reached its limit, the entire system would buckle. But the most dangerous weakness of all was sitting quietly in the banks. In the 1920s, there was no federal deposit insurance. If a bank failed, its depositors lost everything. And banks in that era were not the heavily regulated institutions we know today. They were often small, undercapitalized, and willing to take enormous risks with their depositors' money. Many banks had invested heavily in the stock market itself, not just with their own funds, but with the savings of their customers. They bought stocks on margin, borrowed money to buy more stocks, and then borrowed again against those stocks to buy even more. It was a pyramid of debt, built on the assumption that stock prices would rise forever. And why would they not? The 1920s were, after all, a golden age. Or so the story goes. But if we look closely at the data from the decade, a different picture begins to emerge. Beneath the glittering surface of the Roaring Twenties, the American economy was already showing signs of serious distress. Farm income had been falling for nearly a decade. Consumer debt was at record highs. Wealth inequality was extreme. And the banking system, the very foundation of the economy, was dangerously fragile. The crash of 1929 was not a sudden event. It was the inevitable consequence of structural weaknesses that had been building for years. The speculation was real. The bubble was real. But the bubble did not exist in isolation. It existed on top of a foundation that was already cracked. And yet, despite all of these warning signs, the American people, and more importantly, the American financial establishment, refused to see the danger. They were blinded by the prosperity myth, convinced that the good times would never end. But they were about to get a preview of what was coming. In 1926, a speculative mania swept through Florida. Land prices skyrocketed as investors rushed to buy swampland they believed would soon become prime real estate. The boom was fueled by easy credit, hype, and a belief that prices could only go up. Then, suddenly, the market turned. A hurricane hit the coast, the railroad overextended itself, and the real estate bubble burst. Investors who had borrowed heavily to buy land found themselves bankrupt. Banks that had lent to them collapsed, and thousands of ordinary people who had invested their life savings lost everything. The Florida land crash of 1926 was a warning, a dry run for what was about to happen on a national scale. But the financial establishment did not learn from it. They dismissed it as a local problem, an isolated incident that had nothing to do with the broader economy. They were wrong. The Florida crash exposed something fundamental about the American financial system in the 1920s. It was built on speculation, easy credit, and a dangerous belief that the party would never end. And when the party did end, as it always does, the consequences would be catastrophic. But before we reach that moment, we need to understand one more piece of the puzzle. Because the crash of 1929 was not just a story of greed and speculation, it was also a story of institutional failure, of a central bank that knew the risks but chose inaction, of a government that refused to intervene, and of a financial system that was designed to enrich the few at the expense of the many. And that is where our investigation must go next, into the secret meetings, the private letters, and the decisions that would ultimately determine the fate of the American economy. In the early 1920s, Florida was a sleepy backwater. It had warm weather, sandy beaches, and not much else. But then something happened that would transform the state into the epicenter of the greatest land speculation frenzy in American history, and provide a chilling preview of the disaster to come. The catalyst was simple: a combination of cheap land, easy credit, and the automobile. Suddenly, ordinary Americans could travel. They could pack up the family and drive south to escape the harsh northern winters. Florida, with its mild climate and undeveloped coastline, seemed like paradise. And paradise, in the 1920s, was for sale. Real estate promoters descended on the state like locusts. They bought up swampland for pennies an acre, subdivided it into tiny lots, and sold it to investors at enormous markups. The sales tactics were aggressive, often misleading, and occasionally outright fraudulent. But it did not matter. People were desperate to get in on the action. The promise was irresistible. Buy a piece of Florida land today, the promoters said, and watch its value double, triple, or quadruple within months. It was free money, handed out by the American dream itself. And thousands of people believed it. They poured their savings into Florida real estate. They borrowed money from banks, from friends, from relatives. They took out second mortgages on their homes. They did whatever it took to scrape together the cash for a piece of that golden land. And for a while, the strategy worked. Land prices soared. A lot that sold for $500 one year would sell for $5,000 the next. Fortunes were made overnight. Speculators from New York, Chicago, and Boston descended on Miami, buying up properties as fast as they could. The city of Miami itself grew from a population of 30,000 to nearly 100,000 in just a few years. It was a mania, and like all manias, it was fueled by a single belief, that prices could only go up. But there was one problem. Florida real estate was not actually worth what people were paying for it. The land was mostly swampland, prone to flooding and mosquito infestations. It had little real value beyond what investors were willing to pay for it. And what investors were willing to pay was determined not by the land itself, but by the expectation that someone else would pay even more. That is the psychology of every bubble. It is not about value, it is about belief, and when that belief shatters, the bubble bursts. The first crack appeared in 1925. The Florida East Coast Railway, which carried supplies and passengers to the booming region, became overwhelmed. It could not handle the volume of freight and people. Construction materials could not reach the building sites. Homes and hotels were left unfinished, and the momentum of the boom began to slow. Then came the summer of 1926. The hurricane season that year was devastating. A massive storm swept through Miami, destroying thousands of homes and killing hundreds of people. The damage was catastrophic. Insurance companies, which had been writing policies on Florida properties, faced enormous losses. Many went bankrupt. And suddenly, the dream of paradise turned into a nightmare. But the hurricane did not cause the Florida land crash by itself. It was merely the spark that ignited the explosion. The real cause was the structure of the market itself, the same structure that would later destroy the stock market in 1929. Florida real estate was being bought with borrowed money. Investors had taken on enormous debt to finance their purchases, and when prices began to fall, they could not repay what they owed. The collapse was swift and brutal. Land prices plummeted. Speculators who had borrowed heavily to buy property found themselves bankrupt. Banks that had lent to them collapsed. And thousands of ordinary people who had invested their life savings in Florida land lost everything. By 1927, the Florida real estate boom was a memory. The state was littered with unfinished subdivisions, abandoned lots, and the ruins of once glorious dreams. The local economy had been destroyed. But the rest of the country barely noticed. The Florida crash was dismissed as a regional problem, a localized mania that had nothing to do with the broader national economy. Wall Street continued its relentless climb. Investors continued to buy stocks on margin, and the Federal Reserve continued to look the other way. But the Florida crash had exposed something important. It had demonstrated that speculative manias, fueled by easy credit and a belief in endless price increases, could cause catastrophic losses when they collapsed. It had shown that banks were dangerously exposed to the boom and bust cycle, and it had proven that when the mania ended, the pain would be widespread. And yet, no one learned the lesson. Because here is what the Florida crash also demonstrated: that the institutional safeguards meant to prevent such disasters were completely inadequate. The Federal Reserve had the power to rein in speculation. It could have raised interest rates to cool the Florida boom. It could have restricted bank lending to curb excess. It could have issued warnings about the dangers of speculative mania. But it did none of these things. Instead, the Federal Reserve watched from the sidelines as Florida burned. It believed, or chose to believe, that the boom was harmless, that it would correct itself without causing broader damage. And when it did correct itself, the Fed claimed that its inaction had been justified. The same excuse would be offered again in 1929. There is a pattern here, and it is a pattern that historians have often overlooked. The Federal Reserve understood the risks of speculative mania. It could have acted, but it chose not to. And that decision, to remain passive in the face of rising speculation, was a deliberate policy choice, not an accident. The Florida crash was a warning. It was a preview of the disaster that was coming, and it was completely ignored. By 1927, the Florida land speculation had ended. But the national speculation, the speculation on Wall Street, was just beginning. And this time, the stakes were much higher. Because while the Florida crash had hurt local banks and a few thousand speculators, the stock market crash would devastate the entire American economy. The mania had moved from swampland to stock certificates, but the psychology was exactly the same: easy credit, rising prices, and a belief that the party would never end. The question is not whether the crash was inevitable. The question is why the institutions that existed to prevent it did nothing to stop it. And to understand that, we must look at the most powerful financial institution in America, the Federal Reserve. The Federal Reserve System was created in 1913 with a single clear purpose: to prevent the kind of financial panics that had plagued America throughout the 19th century. Its founders believed that a central bank, armed with the power to control the money supply and lend to troubled banks, could stabilize the financial system and prevent the devastating bank runs that had destroyed so many lives. For the first decade of its existence, the Federal Reserve performed exactly as intended. It helped finance the First World War. It stabilized the banking system, and it earned the confidence of the American people. But by the mid-1920s, something had gone wrong. The Federal Reserve had become captured by the very institutions it was meant to regulate. Its leaders saw themselves not as guardians of the public interest, but as servants of the financial establishment. And they had come to believe that their most important duty was not to prevent speculation, but to protect the profits of the banks. This shift in philosophy would prove catastrophic. The Federal Reserve in the 1920s was led by a group of men who were deeply committed to the gold standard, deeply suspicious of government intervention, and deeply convinced that financial markets were fundamentally self-correcting. They believed that if left alone, the economy would naturally find its equilibrium, that speculative bubbles would burst on their own, and that the banking system would recover without assistance. They were wrong, but they were also stubborn. In 1927, the Federal Reserve faced a decision that would shape the course of American history. The American economy was showing signs of strain. The agricultural depression was worsening. Consumer debt was climbing, and the stock market was beginning to look dangerously overvalued. A faction within the Federal Reserve, led by Adolph Miller, warned that speculation was getting out of control. Miller argued that the Fed should raise interest rates to cool the market and prevent a dangerous bubble from forming. But another faction, led by Benjamin Strong, the powerful governor of the New York Federal Reserve Bank, disagreed. Strong was deeply concerned about the European economy. Britain and Germany were struggling to maintain the gold standard. If they failed, Strong feared, the entire international financial system would collapse. To help Europe, Strong argued, the Fed needed to keep interest rates low. Lower rates would encourage American investment abroad, helping stabilize European currencies. It would also encourage domestic borrowing and spending, keeping the American economy strong. But lower interest rates had another effect. They made borrowing cheap, which made speculation easier. And that, Miller warned, was a recipe for disaster. The debate within the Federal Reserve was intense and deeply divided. Miller and his allies warned that the stock market was becoming dangerously overvalued. They cited data showing that margin borrowing to buy stocks, was reaching unprecedented levels. They pointed to the Florida crash as a warning of what could happen when speculation got out of control. But Strong dismissed these concerns. He argued that the Fed's duty was to support the broader economy, not to police the stock market. He believed that the market would correct itself if it became too overvalued, and he believed that the Fed should not interfere with the natural workings of the financial system. The debate came to a head in the summer of 1927. Strong traveled to Europe to negotiate with central bankers. When he returned, he had a plan. The Federal Reserve would lower interest rates to help Europe, but would simultaneously issue a warning to banks about excessive speculation. It was a compromise, but it was a compromise that would have devastating consequences. The rate cut of 1927 did exactly what Strong had intended. It made borrowing cheaper, which encouraged investment abroad. It also encouraged borrowing at home, and the money flowed directly into the stock market. Margin borrowing skyrocketed. Investors could borrow money at low rates to buy stocks, and then watch their investments rise. It was a recipe for a speculative explosion, and that is exactly what happened. The stock market, which had been rising steadily throughout the decade, suddenly surged upward. The Dow Jones Industrial Average, which had stood at around 100 in 1920, crossed 200 in early 1928. By the end of that year, it would exceed 300. In 1929, it would peak at over 380. But the warning signs were everywhere. The mania was becoming irrational. Stocks were being bought not because they were good investments, but because they were rising. Investors were buying on margin at unprecedented levels. By 1929, the total margin debt had reached nearly $7 billion, roughly equivalent to the total amount of currency in circulation in the United States at that time. The Federal Reserve was aware of this. It had data showing the explosion of margin borrowing. It had warnings from its own economists. It had the example of Florida to remind it of the consequences of unchecked speculation. And yet, the Federal Reserve did nothing. Why? The answer lies in the philosophy of the men who ran the institution. Benjamin Strong and his allies believed that the market was fundamentally sound. They believed that speculative bubbles were self-correcting, that when prices became too high, investors would naturally pull back. They believed that the Fed's role was to remain passive, to let the market do its work, and to intervene only in times of real crisis. This was not merely a failure of competence. It was a deliberate policy choice. The Federal Reserve chose not to act because it did not believe in action. It believed in markets, and it believed that markets, left to their own devices, would always find their way back to equilibrium. But there was another reason the Federal Reserve did not act. It was afraid. Afraid that if it raised interest rates to curb speculation, it would cause a recession. Afraid that if it intervened too aggressively, it would anger the banks. Afraid that if it admitted the market was overvalued, it would trigger a panic. So the Federal Reserve did nothing. It watched as the bubble grew. It watched as margin debt exploded. It watched as investors borrowed to the hilt to buy stocks that were priced at impossible multiples. And it told itself that everything would be fine. The passivity of the Federal Reserve in the late 1920s is one of the great undertold stories of the 1929 crash. Historians have often focused on the speculation itself, the greed, the mania, the madness of crowds. But those were only symptoms. The disease was institutional failure. The Federal Reserve had the power to stop the speculation. It could have raised interest rates. It could have restricted margin borrowing. It could have issued warnings about the dangers of the market. It could have acted as a real regulator, protecting the American people from the consequences of their own optimism. But it did none of those things. And when the crash finally came, the Federal Reserve would make its greatest mistake of all. It would do the exact opposite of what was needed, contracting the money supply at the very moment when the economy needed liquidity. But that story is still ahead of us. For now, we must understand the deeper lesson of the 1920s. The Federal Reserve was not merely passive, it was unwilling to act. It had the power to prevent disaster, but it chose not to use it. Because the men who ran the institution believed that markets were self-correcting. They believed that speculation was a natural part of economic life. They believed that the crash, if it came, would be painful, but ultimately healing. They were wrong, and the American people would pay the price for their arrogance. By the spring of 1929, the warning signs were everywhere, if anyone was willing to see them. The stock market had become a national obsession. Taxi drivers, barbers, housewives, and college students were all buying stocks, many of them on margin. The conversation in cities across America had shifted from football scores to stock tips, and the belief that prices could only go up had become almost religious. But beneath the surface, something was changing. In March of 1929, the market suddenly shuddered. Prices dropped sharply over several days, triggering a wave of margin calls. Investors who had borrowed heavily to buy stocks were forced to sell, pushing prices even lower. It was a small taste of what was to come, a preview of the panic that would sweep Wall Street just 7 months later. But the market recovered. The Federal Reserve stepped in, with a public statement reassuring investors that it would provide liquidity if needed. Prices stabilized, and the boom continued. The March mini-crash was quickly forgotten, but not by everyone. There were voices in 1929 that warned of disaster. One of the most notable was Roger Babson, a successful statistician and investment advisor who had made a career of predicting economic trends. Babson was no crackpot. He was a respected figure in the financial community, known for his careful analysis of business cycles. And in September of 1929, Babson did something extraordinary. He stood before the National Business Conference and delivered a speech that would become legendary. Babson predicted that a stock market crash was imminent. He said that it would be severe, that prices would fall dramatically, that margin calls would trigger a cascade of selling, and that the consequences would be felt far beyond Wall Street. He was ridiculed. The financial press mocked Babson as a doomsayer. Brokers dismissed him as a fool. Investors continued to buy stocks as if nothing had happened. The market barely reacted to his speech. It was as if Babson had shouted into a hurricane and no one had heard him. But Babson was not the only one warning of danger. Some of the most sophisticated investors on Wall Street had quietly begun selling their holdings months earlier. They knew the market was overvalued. They saw the same data that Babson had analyzed, and they made a calculated decision to get out while they could. Joseph Kennedy, the father of a future president, was one of them. Legend has it that Kennedy decided to sell his stocks when he heard a shoeshine boy offering stock tips. If the shoeshine boy was in the market, Kennedy reasoned, the market could not possibly go higher. Kennedy sold his holdings and moved his money into safer investments. He escaped the crash with his fortune intact. There is no single piece of evidence that captures the fever of 1929 better than the stock market statistics themselves. In the first 9 months of that year, the Dow Jones Industrial Average had risen from 280 to 381. That is a gain of more than 36% in less than a year. But the gains were not driven by corporate profits or economic fundamentals. They were driven by speculation. The price-to-earnings ratio of stocks in 1929 was nearly 21, a level that, at the time, was historically unprecedented. Investors were paying $21 for every dollar of earnings. They were betting that earnings would grow forever, and they were betting on margin. By September of 1929, the total amount of money borrowed to buy stocks had reached nearly $7 billion, a staggering sum that exceeded the total amount of currency in circulation in the United States. This was not a healthy market. It was a casino, and the house was about to cash out. The warning signs were visible in the institutional data as well. Insider selling had reached unprecedented levels. The people who ran the largest corporations were quietly dumping their own shares. They had seen the data. They knew the earnings were not sustainable, and they were getting out. But the public did not know that. The public only saw rising prices, the endless stream of headlines, and the promise of easy money. The Federal Reserve had a responsibility to protect the public from this kind of mania. It had the data. It had the warnings. It had the institutional authority, and it did nothing. When Roger Babson made his prediction in September of 1929, the Federal Reserve could have acted. It could have raised interest rates. It could have restricted margin borrowing. It could have issued a warning to investors. It could have done anything to signal that the party was ending. Instead, it remained silent. The Federal Reserve's passivity, in the face of overwhelming evidence of a speculative bubble, is one of the most damning failures in American financial history. It was not a failure of incompetence. It was a failure of will. The leaders of the Federal Reserve had convinced themselves that speculation was harmless. They had convinced themselves that the market would correct itself. They had convinced themselves that their job was to remain passive, to let the market do its work, and to intervene only in times of real crisis. But the crisis was coming, and they were not ready. By October of 1929, the stage was set. The mania had reached its peak. The market was overvalued. Margin debt was at record levels. Insiders were selling. Warnings had been issued and ignored. And the Federal Reserve, the institution created to prevent such disasters, had done nothing. The crash was inevitable. The only question was when it would happen and how severe it would be. The reckoning came in October of 1929. But the story of Black Thursday, Black Monday, and the days that followed is not simply a story of panicked investors and falling prices. It is a story of how the mechanics of the financial system, the rules, the structures, the institutional arrangements, turned a market correction into a catastrophic collapse. The first tremors appeared on September 20th, 1929, when the London Stock Exchange suffered a sudden and sharp decline. British investors had been selling American stocks for weeks, anticipating a downturn. When the London market broke, it sent a shockwave across the Atlantic. The American market wobbled but did not fall. Then, on October 3rd, the Dow dropped sharply again. Rumors began to circulate that large investors were selling. Insiders were getting out. But the real panic did not begin until October 24th, Black Thursday. On that morning, the market opened with a wave of selling that was unlike anything Wall Street had ever seen. Prices plummeted. The ticker tape, which recorded every transaction, fell hours behind. Investors could not get accurate prices. They could not place sell orders. They could only watch as their fortunes evaporated in confusion. The scene on Wall Street was chaotic. Thousands of investors gathered outside the New York Stock Exchange, shouting, pushing, desperate for information. The police were called to maintain order. Crowds surrounded the building, pressing against the doors, trying to get inside. Inside, the trading floor was a frenzy of noise and panic. Brokers screamed orders at each other, trying to execute trades for clients who were demanding to sell. Prices were dropping so fast that brokers could not keep up. Many had to sell at any price, accepting huge losses just to get out of the market. By the end of the day, volume had reached an unprecedented 12 million shares. The market had fallen dramatically. But it had not collapsed entirely, not yet. Then came Black Monday, October 28. The selling resumed with even greater intensity. The market fell nearly 13% in a single day. Investors who had been holding, hoping for a recovery, gave up and sold. Margin calls were triggered on a massive scale. Investors who had borrowed to buy stocks were forced to sell their holdings to cover their loans. And that forced selling pushed prices even lower. But the worst was still to come. Black Tuesday, October 29th, was the day the market truly collapsed. Volume reached 16 million shares, a record that would not be broken for decades. The market fell another 12%. By the end of the day, the Dow had lost nearly 40% of its value from its September peak. Billions of dollars had been wiped out, but those numbers do not capture the human catastrophe. Investors who had borrowed money to buy stocks were wiped out. Banks that had lent money for margin purchases were holding worthless collateral. Many banks had invested their own funds in the market, hoping to profit from the boom. Those investments were now worthless, and many of those banks were about to fail. The crash was not just a market event. It was a banking event, because the financial system was built on a foundation of debt. Debt that had been used to buy stocks, debt that had been used to finance speculation, debt that was suddenly impossible to repay. The mechanics of the crash are crucial to understanding why it was so devastating. When investors buy stocks on margin, they borrow money from a broker to finance the purchase. The broker, in turn, borrows the money from a bank. The stocks themselves serve as collateral. If the price of the stocks falls, the investor must either put up more money, a margin call, or sell the stocks to repay the loan. In 1929, margin requirements were low as 10% in some cases. That meant investors could borrow up to 90% of the purchase price of a stock. It was an enormously leveraged system, and when prices started falling, the margin calls came flooding in. Investors who could not meet the calls were forced to sell. Their stocks were dumped on the market, pushing prices lower. That triggered more margin calls, which triggered more selling. It was a vicious cycle, a cascade of forced liquidation that had no natural stopping point. The Federal Reserve, which had the power to break that cycle, did nothing. It could have provided liquidity, loaning money to banks to prevent them from calling in their loans. It could have lowered interest rates to make borrowing cheaper. It could have taken any number of actions to stabilize the market. Instead, the Federal Reserve watched. It believed that the market needed to purge itself of its excesses. It believed that the crash, however painful, was a necessary correction. It believed that intervention would only make things worse. This belief, as we will see, was catastrophically misguided. But even at the height of the panic, there were moments of bravery. A group of the country's most powerful bankers, led by J.P. Morgan Jr., gathered at the offices of the Morgan Bank and agreed to pool their resources to support the market. They pledged millions of dollars to buy stocks at a time when everyone else was selling. For a brief moment, it worked. On Black Thursday, the bankers' pool succeeded in stabilizing the market. Prices recovered slightly, and the panic seemed to ease. But it was a temporary fix. The bankers' pool could not stop the avalanche of selling. The market resumed its slide, and the bankers themselves began to pull back. They had done what they could, but they could not save the system. By the end of October, the stock market had lost more than a third of its value. Millions of investors had been wiped out. Banks were teetering on the edge of collapse, and the American economy, which had been so confident just months earlier, was now in a state of shock. The crash was over, but the disaster had only just begun. Because the crash of 1929 was not the cause of the Great Depression. It was the opening act, a devastating blow to an economy that was already riddled with structural weaknesses. The real catastrophe was still to come, and that catastrophe was largely self-inflicted. The Federal Reserve, having done nothing to stop the crash, was about to make its greatest mistake. It would contract the money supply at the exact moment when the economy needed liquidity. It would raise interest rates when it should have lowered them. It would watch as banks collapsed, one by one, and do nothing to save them. This is the part of the story that historians have often misunderstood. The crash itself was bad, but the depression, the decade-long economic collapse, was not inevitable. It was the result of policy choices made after the crash. To understand the true origin of the 1929 stock market crash, we must understand not just the events of October 1929, but the decisions that followed. When the stock market crashed in October 1929, most Americans believed that the worst was over. They had watched their savings evaporate, watched the ticker tape fall, watched the panic on Wall Street. But they believed, as they had been told, that the economy was fundamentally sound. They were wrong. The stock market crash had exposed a hidden cancer in the American financial system. That cancer was the banks. The banking system of the 1920s was a house of cards. Thousands of small, undercapitalized banks held the savings of ordinary Americans. They lent that money to businesses, to farmers, to speculators. They invested it in stocks and bonds. And they did all of this with very little oversight and no deposit insurance. When the market crashed, those investments turned toxic. Banks that had lent money for margin purchases found themselves holding collateral that was worth a fraction of what they had lent. Banks that had invested their own funds in the market saw those investments vanish. Banks that had made loans to speculators saw those loans default. And then came the runs. A bank run occurs when depositors lose confidence in a bank and rush to withdraw their money. In the 1920s, there was no deposit insurance. If a bank failed, depositors lost everything, so when rumors spread that a bank was in trouble, depositors had every reason to panic. The first major banking crisis after the crash came in November 1930. A bank in Tennessee, called the Bank of United States, despite its name, a private commercial bank, failed. It was the largest bank failure in American history at that time. The Bank of United States had been heavily involved in real estate and stock market speculation. When the crash came, its loans turned sour. Its depositors, fearing for their savings, rushed to withdraw their money. The bank could not meet the demand. It closed its doors. The failure sent shockwaves through the banking system. Depositors in other banks, fearing that their own institutions might fail, began withdrawing their money. The panic spread from city to city. Banks that had been perfectly solvent suddenly faced a wave of withdrawals they could not handle. They were forced to close. By the end of 1931, nearly 3,000 banks had failed. The savings of millions of Americans had been wiped out. Businesses that relied on bank credit could not operate. Farmers could not get loans to plant their crops. Workers could not access their own money. The banking collapse was not a natural disaster. It was a systemic failure, a failure of regulation, a failure of oversight, and a failure of the institutions that were supposed to protect the American people. But the Federal Reserve could have stopped it. The Federal Reserve had the power to lend money to troubled banks, to provide liquidity when it was most needed. It could have stopped the bank runs by reassuring depositors that their money was safe. It could have prevented the cascade of failures that destroyed the banking system. Instead, the Federal Reserve did nothing. The leaders of the Federal Reserve believed that bank failures were a necessary part of the economic cycle. They believed that weak banks should be allowed to fail, that the system needed to purge itself of its excesses. They believed that intervention would only delay the inevitable. This was not just a failure of competence, it was a failure of philosophy. The Federal Reserve had been created to prevent financial panics. But the men who ran it in 1930 had convinced themselves that financial panics were a natural part of economic life, that they were painful but necessary. They were wrong. The banking crisis of 1930 to 1931 was the true origin of the Great Depression. The stock market crash had been the trigger, but the depression itself was caused by the collapse of the banking system, a collapse that could have been prevented. By the end of 1931, the American economy was in freefall. Industrial production had fallen by nearly 50%. Unemployment had reached 25%, and millions of Americans had lost everything they had worked for. The crash of 1929 was a warning. The banking collapse of 1930 to 1931 was the catastrophe, and the Federal Reserve, the institution created to protect the American people, had failed them completely. Of all the decisions made during the Great Depression, one stands above the rest as the most catastrophic. It was not made in a panic. It was not made in ignorance. It was made deliberately by educated men who believed they were doing the right thing. In 1931, at the very moment when the American economy was collapsing, the Federal Reserve raised interest rates. Let that sink in. The economy was in free fall. Banks were failing by the hundreds. Unemployment was soaring. Industrial production had been cut in half. And the Federal Reserve, the institution created to stabilize the financial system, decided to make borrowing more expensive. It was an act of economic malpractice, a decision so obviously wrong that historians have struggled to understand it for nearly a century. But the decision made perfect sense to the men who made it. They believed in the gold standard. They believed that defending the value of the dollar was more important than preventing unemployment. They believed that inflation, not deflation, was the greatest threat to the economy. They were spectacularly wrong. The gold standard was a system in which the value of a country's currency was tied directly to gold. Central banks maintained reserves of gold to back their currency. If a country's gold reserves fell, it was supposed to raise interest rates to attract foreign investment and protect its currency. In 1931, the United States was losing gold. European investors, worried about instability in their own countries, were converting their dollars into gold and taking it out of American banks. The Federal Reserve's gold reserves were falling. To a central banker in 1931, this was a crisis. The gold standard was sacred. Protecting it was the Fed's primary responsibility, and the only way to protect it was to raise interest rates, to make dollars more attractive to foreign investors, and stop the gold outflow. So the Federal Reserve raised interest rates. It made borrowing more expensive. It restricted the money supply. It did exactly the opposite of what the economy needed. And the economy collapsed. When interest rates rise, borrowing becomes more expensive. Businesses stop investing. Consumers stop spending. Banks stop lending. Economic activity slows. In a healthy economy, raising interest rates can help cool inflation, but in a depressed economy, raising interest rates is a death sentence. The Federal Reserve's rate hike in 1931 was a death sentence for the American economy. Industrial production fell even further. Unemployment rose to 25%. Banks continued to fail. The deflationary spiral, falling prices, falling wages, falling demand, accelerated. The Depression, which might have been a severe recession, became a decade-long catastrophe. The irony is that the Federal Reserve had the power to do exactly the opposite. It could have lowered interest rates. It could have provided liquidity to banks. It could have stopped the deflationary spiral. Instead, it chose to defend the gold standard. This decision, perhaps more than any other, explains why the 1929 stock market crash led to the Great Depression. The crash itself was painful, but it was survivable. What turned a market crash into a decade of suffering was the Federal Reserve's decision to contract the money supply at the worst possible moment. There were voices inside the Federal Reserve who warned against this policy. They argued that deflation was the real threat, that falling prices would destroy businesses, bankrupt farmers, and wipe out the savings of ordinary Americans. They argued that the Federal Reserve should expand the money supply, not contract it. But those voices were drowned out by the defenders of the gold standard. The bankers who ran the Federal Reserve in 1931 believed that inflation was the greater danger. They believed that maintaining the gold standard was more important than preventing unemployment. They believed that the economy would eventually recover if the government stayed out of the way. They were wrong. The Federal Reserve's decision to raise interest rates in 1931 is one of the great policy blunders in American history. It was a mistake of ideology, a commitment to a monetary system that had outlived its usefulness, and a refusal to adapt to the realities of a deeply depressed economy. But the Federal Reserve was not the only institution to make a catastrophic mistake. Across the Atlantic, the British government had just made a decision that would make everything worse. It abandoned the gold standard in September 1931, allowing its currency to float freely. This made British exports cheaper and helped revive its economy. But the United States, led by the Federal Reserve, chose to stay on the gold standard. It chose to defend the value of the dollar at all costs, and that choice had devastating consequences. The gold standard prevented the United States from using monetary policy to fight the Depression. It tied the Fed's hands, limiting its ability to expand the money supply. It forced the Fed to raise interest rates just when the economy needed lower rates. It was a straitjacket, and the American economy was suffocating inside it. By 1933, when Franklin Roosevelt finally took office, the American economy was in ruins. More than a quarter of the workforce was unemployed. Banks had failed by the thousands. Industrial production had been cut by half. And the stock market, which had peaked at 381 in September 1929, had fallen to 42. The crash was not the cause of the Depression. The Depression was caused by policy failures, failures of the Federal Reserve, failures of the banking system, failures of the international monetary system. And those failures were not inevitable. They were the result of choices made by men who believed they were acting in the nation's best interest. They were wrong, and the American people paid the price. While the Federal Reserve was tightening the money supply, another policy disaster was unfolding in Washington, one that would turn a domestic crisis into an international catastrophe. The Smoot-Hawley Tariff Act of 1930 was, on its face, a simple piece of legislation. It raised tariffs on thousands of imported goods, making foreign products more expensive in American markets. The idea was to protect American businesses from foreign competition, to keep jobs at home, and to shield the domestic economy from the effects of the crash. It had exactly the opposite effect. Smoot-Hawley was a disaster from the moment it was signed into law. Other nations, seeing the United States raise its trade barriers, retaliated. They raised their own tariffs on American goods. International trade, which had already been weakened by the global economic downturn, collapsed entirely. Between 1929 and 1933, world trade fell by nearly 2/3. American exports fell by more than half. Farmers, who had already been struggling for a decade, lost their foreign markets entirely. Manufacturers who had depended on exports saw their sales vanish, and the American economy, which had been teetering on the edge, fell off the cliff. The Smoot-Hawley Tariff is widely regarded by historians as one of the most misguided pieces of economic legislation in American history. It was based on a simple but deeply flawed idea that the United States could protect its economy by closing itself off from the rest of the world. But in 1930, the world economy was deeply interconnected. The United States had become a major exporter of agricultural products, manufactured goods, and capital. When the United States raised its tariffs, other nations raised theirs, and the global trading system, which had been fragile for years, broke down. The consequences were catastrophic. Nations that had been struggling to recover from the crash were plunged deeper into depression. The global economy spiraled downward, and the political consequences were equally devastating. The economic collapse helped fuel the rise of extremist movements in Europe, movements that would eventually lead to war. But Smoot-Hawley was not the only policy mistake that turned the crash into a global catastrophe. There was also the gold standard. As we discussed in the previous chapter, the gold standard tied the world's major currencies to the price of gold. It limited the ability of central banks to respond to economic crises, and it forced countries to deflate their economies, cutting wages, reducing spending, and raising interest rates whenever they lost gold reserves. In 1931, the gold standard was a straitjacket. Countries that were losing gold were forced to raise interest rates at the worst possible moment. Countries that were gaining gold, like the United States, were forced to let their money supplies contract, even when they desperately needed expansion. The gold standard did not just make the depression worse, it helped spread it around the world. When the United States raised interest rates in 1931 to defend the gold standard, it attracted foreign capital. European investors, worried about instability in their own countries, moved their money to the United States. This drained gold from European central banks, forcing them to raise their own interest rates. That made their economies worse, and the spiral continued. The crash of 1929 was an American event. The depression of the 1930s was a global catastrophe, and it was a catastrophe that was amplified, if not caused, by the policy failures of the Federal Reserve, the gold standard, and the Smoot-Hawley Tariff. But the most tragic part of this story is that the policy failures were not inevitable. There were alternatives. The Federal Reserve could have expanded the money supply. The United States could have stayed on the gold standard without raising interest rates. Smoot-Hawley could have been rejected or watered down. Instead, the political and financial establishment chose a path that led to disaster. They chose the gold standard over employment. They chose tariffs over trade. They chose ideology over reality. And the American people, and the people of the world, paid the price. The crash of 1929 was a warning. The depression was the consequence. And the true origin of both lies not just in speculation and greed, but in the policy decisions of the institutions that were supposed to protect the economy. We are now approaching the final conclusion of our investigation. We have traced the origins of the crash from the hidden weakness of the 1920s, through the Florida land bust, the passivity of the Federal Reserve, the panic of October 1929, the banking collapses, the Fed's catastrophic rate hike, and the policy disasters of Smoot-Hawley and the gold standard. One final question remains. Was the Great Depression inevitable, or was it the result of choices that could have been made differently? By 1932, the American economy had been in a state of collapse for nearly 3 years. The stock market had lost nearly 90% of its value from its peak. Industrial production had fallen by more than half. Unemployment had reached 25%, and in some cities, it was far higher. But the worst was not yet over. In the first months of 1933, the banking system, already devastated by years of failures, finally collapsed entirely. The crisis reached its climax in March, just days before Franklin Roosevelt's inauguration. The story of that collapse, and the response to it, is the final chapter in the unraveling of the American economy. The banking crisis of 1933 had its roots in everything that had come before. The crash of 1929 had wiped out the investments of millions of Americans. The Federal Reserve's contractionary policies had drained liquidity from the banking system. The Smoot-Hawley Tariff had destroyed international trade, and the gold standard had prevented the government from taking the actions needed to stop the slide. By 1932, more than 5,000 banks had failed. Depositors who had trusted their savings to these institutions had lost everything. The confidence that was essential to the functioning of the banking system had been completely destroyed. In the winter of 1932 to 1933, the banking system finally broke. Bank runs began spreading across the country. Depositors, terrified that their banks would fail, lined up outside their local branches to withdraw their money. In some states, governors declared bank holidays, closing all banks to stop the panic. But those holidays only made the panic worse. They confirmed to depositors that the system was on the verge of collapse. By the time Roosevelt took office on March 4, 1933, the banking system had ceased to function. Banks in every state had either failed or been closed by state authorities. The stock market had been closed. The American economy was frozen. Roosevelt's response was swift and decisive. On March 6th, just 2 days after his inauguration, Roosevelt declared a national bank holiday. All banks in the United States were closed by order of the president. The holiday would give the government time to inspect every bank, to determine which ones were solvent, and to reopen only those that were stable. It was a radical step, but it was exactly what the situation demanded. The banking system needed to be restored to public confidence, and the only way to do that was to close the banks, inspect them, and guarantee that only sound institutions would reopen. Roosevelt also took the United States off the gold standard. The gold standard, which had been the source of so many policy failures, was abandoned. The dollar was allowed to float freely, and the government began a program of monetary expansion designed to end the deflationary spiral. The bank holiday worked. When the banks reopened, with federal guarantees that their deposits were safe, the panic subsided. Depositors began returning their money to the banks. The banking system, which had been on the brink of total collapse, was saved. But the damage had been done. The banking crisis of 1933 was the culmination of everything that had gone wrong since 1929. The crash had exposed the weaknesses of the American financial system. The Federal Reserve's policy failures had made those weaknesses worse, and the collapse of the banking system had destroyed the savings of millions of Americans and plunged the economy into a decade of depression. The story of the 1929 crash is not just a story of greed and speculation. It is a story of institutional failure, a failure of the Federal Reserve, a failure of the gold standard, a failure of the banking system, and a failure of the political leadership to understand the magnitude of the crisis. The crash itself was not the cause of the Great Depression. It was the trigger. The true origin of the Depression lies in the policy choices made after the crash, the contractionary policies of the Federal Reserve, the protectionism of the Smoot-Hawley Tariff, the rigidity of the gold standard, and the failure of the banking system to protect the savings of ordinary Americans. But there is another lesson in this story. The crash of 1929 and the depression that followed changed America forever. It destroyed the belief that the market would always correct itself. It destroyed the belief that the government should stay out of the economy. It created the political will for the New Deal, a sweeping set of reforms that would reshape the American economy and build the welfare state that we know today. The New Deal created deposit insurance, protecting the savings of ordinary Americans. It created the Securities and Exchange Commission, regulating the stock market and preventing the kind of speculation that had led to the crash. It created Social Security, providing a safety net for the elderly and the unemployed. It changed the relationship between the government and the economy, making the government responsible for preventing future depressions. Those reforms were built on the lessons of 1929. But the lesson that historians have often missed is that the crash was not inevitable. It was the result of choices made by the Federal Reserve, choices made by the political leadership, choices made by the financial establishment. And those choices could have been different. The true origin of the 1929 stock market crash is not simply the bursting of a speculative bubble. It is the failure of the institutions that were supposed to protect the American people from the consequences of their own optimism. We have reached the final stage of our investigation. We began with a simple question. Why did the 1929 stock market crash trigger a decade-long Great Depression, when previous crashes had caused only short-term recessions? The common answer, the one taught in schools, repeated in textbooks, and accepted by most Americans, is that the crash was caused by greed and speculation. Investors got carried away, prices became detached from reality, and when the bubble burst, the economy collapsed. That answer is not wrong, but it is dangerously incomplete. Greed and speculation were certainly present in 1929. The mania was real. The excess was real. But speculation alone does not explain why the crash became a depression. There have been many speculative bubbles throughout American history, and most of them did not lead to decade-long economic collapses. To understand the true origin of the 1929 crash, we must look deeper at the structural weaknesses that were hiding beneath the surface of the Roaring Twenties. The first weakness was the agricultural depression. While the cities were booming, American farmers were quietly going bankrupt. Farm income had been falling for nearly a decade, rural banks were failing, and a quiet desperation was spreading across the American heartland. The second weakness was the debt. Americans had borrowed heavily to buy consumer goods, to buy houses, and to buy stocks. By 1929, the total debt burden was staggering, and when the crash came, that debt became unpayable. The third weakness was the inequality. The top 1% of Americans controlled nearly 40% of the nation's wealth. The bottom 90% controlled barely 20%. This meant that the American economy depended on the spending of the wealthy, and when they stopped spending, the economy stopped working. The fourth weakness was the banking system. Thousands of small, undercapitalized banks held the savings of ordinary Americans. They were not insured, they were not well regulated, and they were dangerously exposed to the stock market. The fifth weakness was the Federal Reserve. The institution created to prevent financial panics had become passive, unwilling to act in the face of rising speculation. It had the power to stop the bubble, but it chose not to use it. The sixth weakness was the policy response after the crash. The Federal Reserve contracted the money supply at the worst possible moment. The Smoot-Hawley Tariff destroyed international trade. The gold standard tied the government's hands, preventing the kind of aggressive monetary expansion that could have stopped the deflationary spiral. And the seventh weakness was the political paralysis. Herbert Hoover, the president in 1929, believed in limited government. He believed that the market would eventually recover on its own. He was unwilling to take the kind of aggressive action that the situation demanded, and by the time he finally acted, it was too late. These 7 weaknesses, agriculture, debt, inequality, banking, the Federal Reserve, policy failures, and political paralysis, combined to turn a market correction into a decade-long catastrophe. The crash of 1929 was not a sudden event. It was not caused by a single mistake. It was the result of a system that had been weakened from within, a system that had failed to adapt to the realities of a modern industrial economy. And the true origin of that failure lies not in Wall Street, but in Washington, in the Federal Reserve, in the Treasury Department, in the White House. It lies in the decisions that were made and the decisions that were not made by the men who were supposed to protect the American people. Let us return to the question we asked at the very beginning of this documentary. Was the 1929 crash merely a speculative bubble bursting, or was it the inevitable collapse of a deeply fractured economic system? The answer, we now know, is both. It was a speculative bubble, one of the greatest in American history. But it was also the collapse of a system that was already broken. The bubble was the symptom. The disease was institutional failure. And the lesson of 1929 is not that markets are dangerous, or that greed is bad, or that speculation should be controlled. The lesson is that institutions matter. The institutions that were supposed to protect the American people failed them, and when those institutions failed, the American people suffered. The crash of 1929 changed America forever. It destroyed the belief that the market would always correct itself. It destroyed the belief that the government should stay out of the economy. It created the political will for the New Deal, a sweeping set of reforms that would reshape the American economy and build the welfare state that we know today. But the lesson of 1929 is still relevant, because the same institutional failures that caused the crash still exist. The same weaknesses, unchecked speculation, excessive debt, inequality, regulatory capture, political paralysis, still threaten the American economy. The true origin of the 1929 stock market crash is not a story that ended in 1933. It is a story that continues to shape American history, and a warning that we ignore at our peril. We began this documentary with a question about the past. We end it with a question about the future. Have we learned the lessons of 1929, or are we destined to repeat them? The answer, as always, is up to us.